And so the script has flipped at this point in time, and the U.S. is now in the position of these other countries were back during the past inflation crises. And that's why I expect U.S. inflation to continue to rise, U.S. current account deficit to continue to get worse as we do not manufacture in this nation, that the U.S. dollar index will eventually trend down, and that further, the pressure that we have on bond yields and the yield curve inversion, the recession means that higher bond yields are not going, or at some point going to stop convincing investors to buy them. Because even though we have 4.14% on the U.S. 10-year as of yesterday, the CPI is 8.3%. So investors are losing about 4% on their investment. Everybody, this is Rob Kientz of GoldSilverPros.com doing a special report for JM Bullion, and this report is going to be put out on October 20th, 2022. So I get a lot of questions from people as to why the gold price is falling right now, and some of what the normal market pundits will note on that is that we have a rising dollar, as well as we have rising interest rates on bonds, and I'll explain why those are considered to be counter-cyclical to a rising gold price, or if the rest of the rest of the world's piling into dollars and bonds, why would they need to go to gold? Because dollars and bonds are a safe haven. And I'm going to challenge that thought a little bit here today by going over some of what has happened in the past, and while that possibly cannot happen in the future because economic fundamentals that we have now are much different. So I'll jump right into the presentation, and we're going to start by looking at a chart of the U.S. 10-year Treasury yield. So this is the amount of money that you would get for buying a U.S. Treasury. And we can see over time that this rate has risen. So the Treasury yield has risen, meaning the 10-year has a higher yield or higher interest rate than it has before. And there are a couple of things that I want you to pay attention to on this chart, which I've got highlighted. There are multiple breakouts of the interest rate above the 50 and 200-day moving average. And when that happens, and this is your 50 and 200-day moving average lines here, and when that happens, it means that bond investors are demanding more yield due to risk in the environment, and that when it breaks and stays above the 50 and 200-day moving average, it's basically a breakout. We don't expect those interest rates to really fall for quite some time, at least not substantially. And also giving the fact that the Federal Reserve, our nation's central bank, has stated that they want to continue to tighten by raising their federal funds rate up to 4.4% by the end of this year or in early 2023, means that we're more than likely to have bondholders demanding higher interest rates. Now, what happens when you have higher interest rates is actually not good for the economy because, one, it increases debt service costs, not only for the U.S. itself, but also for corporations and individuals. It tends to slow the economy when interest rates are rising. Another interesting thing to note on the chart is they keep breaking out. So right here, we have a relative strength indicator chart, or an RSI chart. And when the squiggly lines go above 70 on the RSI, it means it's typically overbought, and we would expect it to come back down, meaning interest rates would fall. So in cases here, you can see it's overbought territory. Interest rates fell a little bit, overbought territory. We really didn't have interest rates fall here. It was interesting. A little bit overbought, they fell a little bit. A little overbought here, a little bit of a fall, but a continued rise. So even though the market is seeing higher than average rates of interest rate increases on the 10-year, it's not causing a reversal in the market as the RSI indicator would typically show us. In fact, if anything, there's appetite for higher and higher interest rates on the 10-year, signaling that there is more risk in the system. Down here on the MACD chart, I wanted to explain what's going on here. Whenever you see the MACD, which is basically a moving average of 12, 26, and 9 periods compared against one another, and whenever you see that widen, and you can see that widen by the bars here, the higher the bar or the lower the bar, the bigger the difference is between the current moving average and what the signal line is telling us, means that the market is schizophrenic. In other words, it doesn't know which way it should go. It seems like about half of the people think interest rates should fall in the 10-year, half think that it should widen. People are waiting for it to fall. Why? Because you're seeing these RSI indicators saying interest rates have gotten too heavy or gotten too high too fast. But even though these technical indicators are indicating a divergence of the market where people are expecting rates to fall in the 10-year and they're not, and the RSI indicator is indicating that the rates have risen too much and need to cool off and they're not, means that there's excessive risk in the system. Not only that, but we'll get to a yield curve inversion here in a moment. We'll explain that near-term risk seems to be rising faster than long-term risk when measured in bond rates. So it's a complicated eye chart here, but just to show you the bond market, which some of the smartest investors, in the market are expecting higher rates. We've had breakouts above where those rates normally would have come down in a normal market. And we've had the technical indicators tell us that they expect that the rates should be coming down or reversing soon, but they're not, and that the market keeps absorbing higher rates and demanding more. That's because risk is rising. So that's the base case I want to make for investors see risk rising and they're demanding higher rates on treasuries, which is going to put additional pressure to service the debt on those treasuries. But the market is saying we're not out of the woods yet. That's what this chart is telling us. I also want to do a nice little chart here from the Fed over yield curve inversion. So yield curve inversion is when a shorter term bond issuance, the benchmark is the 2-year in the US, trades at a higher interest rate than the benchmark long-term index, which in the US is a 10-year treasury. So you compare the 10-year and 2-year as the Fed has on this chart. This is put out by the St. Louis Fed on their information system called FRED. And you can see that there is a pattern here. Whenever the 2-year rate or the short-term rate is demanding higher interest rates, we're seeing more short-term risk in the market. That's why they're demanding those rates. We have a recession. In fact, this indicator is basically perfect in history for the times that it's been measured. I think the last 7 times that the 2-year treasury traded at a higher rate for any substantive length of time above the 10-year, it means bondholders were seeing more near-term risk. And true to form, we had a recession in the United States. Here's a recession from the last time this went negative. Here's a little mini recession from when it touched on going negative back in 2019, right before 2020. Of course, that was before the pandemics and the shutdowns. And then, of course, we see a much more protracted move of the 2-year above the 10-year at a much faster pace than we even had back during 2006, 2008, before the big 2008, 2009 recession called the Great Recession. We've had a much more protracted and faster move of the 2-year rate rising higher than the 10-year rate, which means not only do bond traders see the threat of recession coming, they see it coming hard and fast, because you can look at just how fast this went below the line and stayed below the line. Whereas before the 2008-9 crisis, it was a nice sort of gentle, stay below the line a little bit, come back up, and then we had a recession. Here, this is a sharp jog below the line, and it keeps getting worse. The 2-year is still rising faster than the 10-year. That is a big recession indicator, and this is your signal. When the difference between the 10 and 2-year is falling, that's your signal the recession is probably approaching. When it goes below, recession forms. Same thing here, although we've had a longer, more protracted fall down this time, and then a bounce, and then a very sharp fall. So this, what we see right now, looks very much like what we saw before 2008, 2009, a very protracted decline. This was the market acknowledging that near-term risk was rising, but slowly, because the economic data was still positive enough that the market still stayed positive and still went bullish on stocks and bonds. This is a sharp reversal in the 10 to 2-year inversion, which indicates now bondholders are serious that we're in the middle of a recession or the recession is coming. So, however, going back to that chart, traders will still continue to trade the bonds when they have higher rates because they get higher rates of return back. That will happen up until a point at which people see so much risk in the system short term that people dump bonds. We're not quite there yet. That's why bond rates are rising and people continue to gobble them up. As we saw on the first chart that I was presenting you, people will stop gobbling those up when they realize the near-term risk is so strong they don't want to be in bonds, and they'll dump bonds. We haven't gotten to that capitulation point yet. Another thing I wanted to do is compare gold price to the Treasury, U.S. Treasury, and this is over about a 20-year chart. And you'll notice that U.S. 10-year rates have steadily fallen since the early aughts. Just a nice steady line here overall. Although they're rising again, the line would have been a little bit sharper drop. But you could see this very sharp rise since 20. And since the shutdowns, this rising 10-year interest rate means that investors expect more and more risk in the economy. However, gold has been falling lately, and that seems counterintuitive. Why is gold, the ultimate safe haven asset, falling when there's pressure on U.S. Treasuries? Well, that's because the aforementioned point I made, that when U.S. Treasuries rise in this little channel, more people demand them because they're going to get returned short term. However, when this channel continues to rise up to certain levels, what will happen is people will realize that the return on bonds is not worth the risk that they're taking, and they'll go back into gold. So when the bond rates rise, it puts downward pressure on gold because people are like, well, gold is not returning. Even if you lease it out, you're getting 1% or whatever the thing is. And for those that can't lease it, the thought is, well, gold needs to fall. We've got rising returns on treasuries. The stock market was doing well up until recently, when we started having negative quarterly earnings reports overall for the US. And so that is negative for gold. People see the return of the treasury market. They say, 4% is still okay. US could still afford to service their debt. At what point does this reverse, however, in which people start dumping bonds and go back into gold? We're not at that capitulation point yet, but I would point out over the long term, the risk has been showing higher gold prices. There's more risk in the system, and people are wanting higher gold prices to compensate for that. I also want to point out that during 2008 and 2009, gold and bonds rose in tandem for a short while because risk on, right? You have massive issues in the mortgage market. People demand higher interest rates for the treasuries. And then when we get out of the woods, those interest rates start to fall again because of TARP programs and all these easing programs. The rate on the 10-year began to fell because people didn't think that there was short-term risk. And so gold rose in that environment because the gold holders remembered what went on here during the last recession, but gold eventually fell again. But what has happened is investors have gotten wise to the risk in the system. They bid up gold. And even though bonds are short-term returning more money, I think this overall gold trade has been relatively sideways the last couple of years, but is probably set to break out. Why? What's going to happen? Well, we'll talk about that as the show goes on. Here, I wanted to look at the DXY chart, and the other reason people say that gold is falling, and I've basically debunked this before, but we're going to do it a different way this time. When the dollar is strong, as shown on a DXY chart, which is the dollar against a basket of other currencies, generally that signals strong US economy. People see the need for less gold. That will drop the gold price. You can see here that we've hit a little point, an historic point on the dollar chart where we hit 112, and that is a bullish sign for strength of the dollar. And so when people see short-term dollar strength, they think short-term gold weakness, and so they sell off. Remember, you got US Treasuries returning a nice percent for the first time in a long time. And so people are piling into them to get the return, and people see the strong dollar. And that's why you've had a little bit of gold sell off, I think. However, I'm going to talk about why this DXY chart is probably set to reverse here, because we have different situations. And I'm going to get into some research to back that up. So just on the chart, I want to show some of the things that occurred during 1983 time period, 1984, when we had the last peak of the dollar. I'm going to show you a paper which shows that we had strong manufacturing and exports, declining energy costs around the world after the energy crisis that occurred in the late 70s, and the rest of the world recovering from debt issues, where the U.S. was, compared to them, in a much better position. That's why the U.S. dollar strength rose that much. The last time we had it cross this little Maginot line here on the chart, 1999 to about 2002, 2003, the U.S. is still doing well. Our U.S. share of global wealth was very high. The current account deficits were very low. It was in the 4.5% to 5% range, meaning we were still strong a manufacturing nation. And so therefore we are importing and exporting about the same, only importing a little bit more, but still very strong there. And the U.S. equity asset market was still very, very strong at the time. And it was strong based upon strong fundamentals, not just algorithms at that time bidding up the market and pushing excess dollars into it like we see now, but actually strong earnings reports and a strong U.S. corporate market, which we don't have now. Now, if you look at the chart, we have a bunch of things that are different. Current account deficit's high, meaning we import way more than we export. Part of that is because we have a strong dollar price, but a lot of that has to do with we no longer have manufacturing, which makes us weak fundamentally in the economy. It affects our current account balance and has too much money going the other way, which, by the way, exports inflation to the rest of the world, which explains why the rest of the world currently is struggling with inflation more than the U.S. is. They're struggling with excess dollars due to the strength of the dollar and the fact that U.S. doesn't manufacture anything. All those excess dollars that we've been printing out have been going to the rest of the world for inflation. And I'll show you in subsequent videos how that money's starting to come back and is starting to cause inflation here in the U.S. It's starting to boomerang back around from the rest of the world to us. The U.S. also has record levels of sovereign debt. You have de-dollarization, which I just mentioned, by BRIC nations. Well, now the China and Russia are forming their own basket of currencies, their own super currency based on a basket of currencies by the BRIC nations. And we start to see persistent high inflation here in the US as well. And that's why the dollar, I don't expect to continue to be strong. This DXY chart will eventually reverse. And it's not the same situation that we had in the previous eras in which we had a strong dollar. And I want to show you why. We're going to share screen on some research studies that I did and showing you exactly why this would be the case. And getting to those charts, just a moment on the share as we get everything organized. Here we go. So here is, I'm going to be right here on slide 68, but this is a study done by Catherine Mann, How Long the Strong Dollar. I'm going to be referring to that 1999 to 2003 section of the chart where we had a strong dollar. And the case was that the U.S. current account as a share of GDP was strong, and net investment as a share of GDP was strong. But going to these two charts, the most important thing to remember, the U.S. share of equity assets in the global portfolio, meaning what we owned in the global portfolio, was very strong. There was a lot of wealth still here in the U.S. It's different now in that a lot of the wealth has been pushed out to the rest of the world. The rest of the world market is getting stronger compared to the U.S. It's the opposite situation. The other piece of it is the U.S. share of change in global wealth. The U.S. always had a strong percentage of global wealth in its portfolio. Now it's more of a debtor nation, and the U.S. percentage of global wealth is not as strong as it was. So those are different factors in relation to the strong dollar. Here's another report by Robert Solomon on the effects of the strong dollar. There's information I want to bring to you here as well. And the main thing that I want to talk to you about is the percentage of manufacturing that we had that of our overall GDP that supported a strong dollar policy that we do not have anymore. And there's a nice little chart that he has in there explaining that, where we've got the dollar as a percentage overall of global trade. And we'll get into that table here in just a moment. When you have a strong manufacturing nation and you have a strong percentage of your country export, in terms of export as a percentage of the overall percentage of the world, then that means you're going to have a strong dollar. And right now we have the opposite. We have inflation. We have dollars coming back. We do not have strong exports. And that has become an issue. And we're going to see that here in the table in the study. Here we go. This is the one at it. So this is the good output of the U.S. from 1950 to 1985. Here is the GDP. If you look at divide goods output in the U.S. by GNP, gross national product, as a percentage, you see we were running in the 40s here, meaning our overall goods output was strong during that period. Our manufacturing is cratered to where this is no longer true. So when you don't have a lot of domestic export to support your strong dollar, all that happens is your dollar gets pushed out, your strong dollar gets pushed out into the world through us buying goods that we no longer produce. And then all of that builds up over time. All of those excess dollars across the world build up over time. And when the rest of the world needs to dump them to support their economies, when inflation is getting too high and they need to dump US dollars, they're dumping it back in the market and it's coming back to the US. And that's exactly what has happened. There is another one talking about, and these last two articles are really referring back to the previous period, the previous chart, not the 2000s, but the 1980 to 83 when we had strong dollar, pointing out the differences. We had declining energy costs back then, a slower pace of recovery abroad, and developing nations' efforts to service heavy international debt loads. We still have developing nations servicing heavy international debt loads, but they're doing it through forming their own trade. They're forming their own trade markets, and we have rising energy costs, meaning that the dollar is not going to be supported by cheap energy and the rest of the world trying to fix their financial situation. The rest of the world has a increasingly better financial situation, and they're dumping US dollars back in the market to come back to the US. And so now we're getting our own treatment. And so the script has flipped at this point in time, and the US is now in the position of these other countries were back during the past inflation crises. And that's why I expect US inflation to continue to rise, US current account deficit to continue to get worse as we do not manufacture in this nation, that the US dollar index will eventually trend down, and that further, the pressure that we have on bond yields and the yield curve inversion. The recession means that higher bond yields are not going, or at some point going to stop convincing investors to buy them. Because even though we have 4.14% on the US 10-year as of yesterday, The CPI is 8.3%. So investors are losing about 4% on their investment when inflation is higher than the bond rate. So bond rates need to spike more while we have persistently high inflation, and that puts tremendous risk on the sovereign and corporate debt systems, which means I think that's a bullish outlook for gold in the long term. And when we have a reversal in people wanting US bonds and we have a reversal in the dollar index, that means the long-term chart for gold is going to be bullish. So even though short term, these rising interest rates on the 10-year treasury and the 2-year treasury and the strength of the dollar are putting downward pressure on gold, this is just a short-term phenomenon. The derivative traders on COMEX that determine the spot price of gold are going to flip their trade on gold when they realize what is going on in the underlying fundamentals of the economy. But that hasn't reached them yet. They're still seeing yields in other markets where they're taking those yields and they see a strong dollar, and that's a signal for them to sell and a signal for the algorithms to sell. But when sense comes back into the market and the underlying economic fundamentals are recognized for what they are, that trade is going to flip. The derivative traders on the COMEX will go long gold and we'll start to see the price rise again. So short-term pressures doesn't mean anything in the long term. And I showed you the historical data on that. The differences between the 80s and the 2000s versus now is a completely different situation that we have and why I expect both gold and silver prices to continue to rise. All right, that has been your weekly research report here at JM Bullion as powered by Gold Silver Pros. This has been your host, Rob Kientz. Till next time.